Sadly, nobody can see the future. Only hindsight's 2020. I I've joked with you before, Dunnigan, that bearishness hasn't paid for me. Doug Casey and I joke that we've accurately foreseen 17 of the last 3 recessions. And so I try to stay partly in the market, but I also maintain a fair bit of liquidity, in effect, attempting to have my cake and eat it too. We've talked before, too, Dunnigan, about the fact that having cash necessarily means negating purchasing power. If you're receiving 4.5 or 5% on your savings, and the purchasing power of your savings is declining at 7.5% compounded, it means that your purchasing power is declining by 2.5% a year, which is unpleasant. But if you believe that there is a reasonable chance of a decent decline and an outside chance of a liquidity event like 2008, then I think that you have to be reasonably liquid, which I am. Now, I need to say that in my life, I've made money on the micro, not on the macro. I've made money by studying individual companies in greater depth than other people have, and deciding sometimes that almost irrespective of the big picture outcome, that something is cheap enough, or at least that the juxtaposition of risk to reward is attractive.
With inflation outpacing savings rates, 7.5% versus 4.5%, holding onto cash is costing you more than you think. Rick Rule warns of a looming liquidity event, one that could rival the 2008 crash, making liquidity critical despite the loss in purchasing power. Cash might seem like a safe bet, but Rule believes that without a plan, it's a risk on its own. He's been through this before, making his fortune by preparing for moments like this, and now he's offering insights on how you can do the same. Is your portfolio ready for what's coming next? While many investors are caught up in short-term gains, Rule emphasizes the importance of long-term strategy, especially in times of uncertainty. He points out that the real danger isn't in the market itself, but in how investors react when volatility strikes.
So while I believe that Biden is a risk, Biden's not a risk anymore. He's on the beach where he can do no harm, which is great. If you believe that Ms. Harris is a risk, and if you believe that Trump is a risk, I would point out to you that both are true. But your greatest risk is you. Your greatest risk is not controlling your emotions, not doing enough work. Don't let Trump or Harris be an excuse to fail. Remember that it's your money and the buck stops with you. I need to say that I am concerned in the intermediate term that so many of the idiotic policies of both candidates attract anything but widespread skepticism and scorn among the electorate. But I'm not going to let that intermediate term concern keep me from making money. I was going to say that I would try to make money despite them. That's wrong. I'm going to try to make money to spite them. Among other reasons. I suspect that should Ms. Harris be elected, that the market will perform less well in the near term than should Mr. Trump be elected. The reason for that is that most investors are or seek to become rich people. And Ms. Harris is running on a determinedly populist theft agenda. The idea of taxing unrealized capital gains is a completely preposterous idea, but the fact that it's attracted so much positive attention is a little scary in the long term. It makes a professional investor like myself feel sort of like I'm walking down the street with a bullseye painted on my back. I don't expect her to get away with it. You know, those Wall Street backers of hers who have always prevented, as an example, the carried interest exemption from getting taken away, probably have a little visit with her, slap her around a bit after the election. But what bothers me isn't so much the proposition as its popularity outside the Beltway. And that is scary. Not to be outdone, some of Mr. Trump's proposals exhibit a real profound weakness with mathematics. And the fact that people appear to take him at face value sort of tells me that a distressing number of Americans never got beyond grade 5 or 6 math. It's an odd circumstance out there. It reminds me a bit of when I was in my late teens, in the early part of the decade of the 60s, and I was listening to the blandishments of all the people running for office and looking at the circumstance around me and expressing some skepticism about my future from a macro viewpoint. My grandfather said, you know, son, my generation had the odd challenge too. The Great Depression, World War II, Hiroshima, Nagasaki. You'll get through this just fine. And that's what I would tell people who are letting their concern about the big picture get in the way of doing the work necessary to invest their money. It wouldn't surprise me to see a little correction in the gold price, given there's so much confidence in the market. If the Fed does cut interest rates and gold doesn't respond dramatically, then the next move in gold is lower, which I'm okay with. I don't measure gold in weeks or even months. I measure it in years. And I feel very comfortable about what gold has done, starting with a starting point in either 1970 or 2000. I'm content in both circumstances. The discussion of gold and the gold stocks is much more nuanced. It goes like this. If you believe gold is going up, buy gold. That's insurance. You buy the gold stocks for a different reason. You buy them because you believe that they're companies that will outpace their competitors, or at least as a class, outpace the market. I would remind your viewers, or inform them if they didn't already know, that sometimes the gold miners can dramatically underperform gold. I point to the period 2000 to 2010, when the gold price advanced from about $250 to about $1,750. And the free cash flow per share on the XAU fell. It took real skill for the mining industry to turn a 7-fold increase in the selling price of their product into a reduction in free cash flow per share. But they did it. They accomplished the impossible. They put stupid projects into production. They did stupid mergers and acquisition. Importantly, they issued enough shares. In other words, they inflated their share counts dramatically enough that the free cash flow per share declined. I would urge your listeners to consider, too, we've talked about this before in your program, that if you come down to the junior miners, or those that purport to be miners, the junior mining companies per se, if you merged every one of them in the world together and formed one company, we'll call it Junior Explorco, that company would lose $2 billion a year in a good year and $6 or $8 billion a year in a bad year. So what do you pay for that industry, Donegan? Do you pay 8 times losses? 12 times losses? If it's in favor, 15 times losses? So there's reason for caution. On the other hand, both of those statistics hide the fact that the finest mining companies perform extraordinarily well. In the juniors, probably 5% of the 3,000 public companies worldwide generate so much performance that they add legitimacy and sometimes luster to a sector that loses $2 billion a year. And among the seniors, you don't have to own the XAU. You don't have to own all 40. You can own the 5 or 6 best companies. Yes, they are premium priced compared to the others by most metrics. And 2, if the gold price really goes on a romp, it'll be the inefficient companies that outperform the market, not the most efficient companies. In my declining years, Donegan, I'm okay if you take away some of my upside, provided that you take away most of my downside. So I would urge your listeners, irrespective of their focus on the big ones or on the little ones or on some of both, that they focus more on stock selection than on the gold price.
Today, we explored Rick Rule's insights on the potential for a major liquidity event and how staying liquid, while painful due to inflation, can be a key defensive strategy. We also covered the importance of keeping emotions in check, staying focused on solid investments, and not letting fear of the bigger picture keep you from making smart moves. Remember, the key takeaway is preparation. Whether that's holding cash, investing in gold, or finding undervalued companies, your portfolio should be ready for what's ahead. Thank you so much for watching. If you found value in today's video, don't forget to subscribe, hit the like button, and share your thoughts in the comments section below.